I see this question pop up every single day in trading discords and across social media. How do I calculate my risk and stop loss while trading options? The typical answers you'll hear: risk 1% of your account or 10% of the option premium. But here's the problem. These answers come from traders who are now trading large accounts, and they have forgotten what it feels like to trade with a smaller account size. I started small, just like most of you watching this video. And after some trial and error, I have discovered a risk management approach that actually works for small accounts. One that has helped me grow my account sustainably without blowing it up. I'm going to be sharing what I have learned about option risk management that most traders get wrong. Stick around because this could be the difference between growing your account and losing everything. If you already trade options, you probably know all these terms on my screen. But for the sake of those that just don't know about options and came across this video, you want to take notes and leave a comment if you want me to make a detailed video about options and how to start trading options and all the things to know to succeed at trading options. I can make that video if there's demand for it, if I get likes and I get enough comments to drive me to be able to make that video and spend time explaining these things. For the sake of this video, you buy a call option when you are betting that the stock is going to go up. You buy a put option when you're betting that the stock is going to go down. It's a way of shorting the stock. In this video, I'm going to be mentioning the strike price and expiration date quite a lot. So that's why I have them defined here. The strike price is basically the agreed upon price at which the stock will be bought or sold. If you're day trading, the strike price is important to you because that's your target price. That's the price you feel like the stock is going to make a move to. The expiration date is important because if you're trading options, you don't want to let the contract expire on you unless you are exercising the option contract, which is an advanced concept and not really relevant for day trading. When day trading options, you need to understand the three main Greeks, which is the delta, the gamma, and your theta. Now, there are actually 5 Greeks, but the other 2 I'm not going to mention in this video because you don't really need them for day trading. I'm going to explain the delta, the gamma, and the theta so you can understand why they are important to manage your risk. The delta basically measures how much the option price changes for a dollar change in the underlying price. How much the option price changes for every dollar change in your favor or not in your favor. So you want to use this to size your trades properly. I'll explain how to use this shortly. Stay with me. And then you have the gamma, which measures the changes in the delta. As your delta changes, your gamma would also change. So your risk could drastically increase if you don't cut your losses fast when you're trading options. So it punishes you, gamma punishes you when you are wrong and you continue to hold on to those trades. Then you have the theta, I don't know if I'm pronouncing that, the theta, which basically measures time decay, how much the option price would decrease the closer you get to expiration. So with options, you want the move to happen quick and fast before your contract expires. So if you're day trading weekly options, the same contracts that expire the same week, you want to avoid choppy setups or range days because theta would be kicking into those contracts and it will lose value. And even worse when you're trading same day expiration contracts. So you need to understand how to use the delta, the gamma, and the theta to your favor so you can manage risk, because options is not really forgiving. If you're wrong, be wrong fast. You can find the delta, gamma, and theta on the option chain in your broker. Here is in the video option chain in Interactive Brokers. You have calls on your left and puts on your right. In this example, I will be going over the Greeks for the 175 NVIDIA calls. Here you have the gamma, the delta, and the bid and the ask of the option contract that you're trying to buy. The gamma here is 0.0057. What does that mean? It means that for every increase in your delta, you would have $5.70 increase in the option contract. You want to always remember to multiply by 100 when you're looking at this option chain. The reason for that is because with options, it's treated like you're buying 100. One option contract is equal to 100 shares underlying stock. So one option contract is the same as similar to buying Nvidia at $175, 100 shares of Nvidia at $175. So that's why when you're looking at the option chain, you need to multiply every factor, the numbers by 100. So your delta in this case is $42.90, right? For the 175 strike price. The price of the contract on the bid and the ask is going to be anywhere from 211 to 214, depending on if you got filled on the bid or the ask. I hope that's clear. I could go over it again, but I hope that's clear. So we've gone over the option chain and I've explained things, and you're probably wondering, so wait, how do I manage my risk? Let me show you how. In this example, I'm going to explain using a $1,000 account size, how to manage your risk. And then I'm sure you can use that and apply it to other account sizes that are below the $25,000 mark. So if you're trading Nvidia and you believe that Nvidia would get to, again, your strike price is the price you believe it would at least get to, 175 within a couple minutes, and it's trading at 174, 20 something cents, whatever, and you have a $1,000 account, you cannot use the same metric as, oh, only risk 1% of your account per trade, because 1% of this account is $10. You cannot use this when trading options. You can also use the metrics of risk 20% of the option contract, because 20% of the option contract is about what, 22 bucks, 23 bucks. That's not realistic with options because you have other factors driving the price. It's not as linear. So with that being said, you want to use the delta of the option contract as your minimum risk, like as a baseline, because with the delta, you'll probably maybe have like some slippage when you get filled. You might lose a little bit more, or you might also lose less. At the back of your mind, if you accept, okay, this is how much I'm willing to lose, because that's how option contracts move, right? Like for every dollar move in the stock price, your delta would change by $42. So in this example, if you enter Nvidia here at 174 and your stop loss based on this setup is 173, if you were to stop out exactly at 173, you will lose $42 per option contract. That's the amount you will lose. And if you continue to hold, that's even worse, because then gamma would kick in, and that $5.70 that I talked about earlier will be added on to this $42, and it would be your delta would then become 42, 47 and 70 cents, and then it continues to roll over like that. So that's why with options you want to be right fast and you want to be wrong faster and like get out of the trade. So if you bought one option contract at 214 and you stopped out exactly, you will lose $42 on that trade, which is fine because it gives you more ammo to continue to like trade. If you know what you're doing, there's no way you're gonna like $42. If you lose 10 trades in a row, which is unlikely unless you don't know what you're doing, you will still have at least 50% of your accounts to continue to battle back. Okay, if you do win this trade, same thing happens. $42 gets added onto the option contract price, and for every dollar after it gets to 175, then you get gamma that would kick in. And potentially, if it even gets to 176, right, you will end up with about a $90 profit on that one contract. So technically, you would have risked $1 to make $2. And that's what you not always, but you typically want to aim for when you're trading options. Now, I mentioned something about time decay with the theta, right? When you're trading options, you want to avoid choppy days because your theta, it actually is playing a role. From Monday to Wednesday, you probably don't feel the impact or you don't see the impact. But from Thursday, if you're wrong, decay happens really fast. Decay, the factor increases the closer you are to expiry date. So at the beginning of the week, you might be losing $1 like as the contract moves away, like in the wrong direction, or you may be gaining $1 as the contract moves in your direction. But as you move closer to expiration, for example, if you're trading on Thursday and your contracts are expiring on Friday, even worse, if your contracts are expiring the same day, you want to be right quick. And if you're wrong, you want to get out of those trades really quick, because it could go to zero, go to nothing really fast. So for me personally, from Monday to Wednesday, I would trade the same week expiration contracts, sometimes Thursday. But what I would then do is try to be on Thursdays, try to take in the money contracts. Like if I was trading NVIDIA on a Thursday in this example, I would probably take the 174s. I won't go further out the money. And on Fridays, I would typically not trade the same day expiration. I would go a week out, because on Fridays you don't want to like risk your profits or risk blowing your account after all the hard work. You want to be in protection mode. You go a week out and you trade stress-free. Meanwhile, people are like, oh, 0 DTEs, and some people know how to trade them well. But for me, I feel like if you're a beginner and you also have a smaller sized account, it's better to go a week out so that your theta is not eating away at your contract so fast. You want to give the trade room to work. So with that being said, I'm going to give you this tip, because I know while you're in the trade or while you're about to take a trade, you don't have that much time to do this math of how much is the gamma, how much is the delta. Like you probably don't even see it when you're about to enter a trade. But if you're trading these names, listen carefully. If you're trading NVIDIA, you're trading AMD, you're trading QQQ and SPY, the delta for contracts that are one out of the money, the delta is usually anywhere from $30 to $50. That's what I've noticed. Now, if you're trading Tesla, the delta for Tesla is anywhere from around 40 to the 60 mark for a dollar move in Tesla. And you know Tesla moves really quick. And then with Meta, that one is really tricky, because Meta in one candle can move $2, $3. It's similar to Tesla. So for people with smaller sized accounts, just stay away from Meta until you know how it moves and you know how to use the option Greeks to manage your risk. Trade names like SPY, QQQ, NVIDIA, AMD, Apple, you're able to at least account for $50 per option contract if you're wrong. That way, you're able to decide. Feel like you can lose $150 per trade, then you want to buy 3 to 4 contracts. If you feel like you can lose only $50 per trade, then you want to buy 1 contract. That's just my rule of thumb for trading options using the Greeks. If you enjoyed this video, or if you found value from this video, please leave a comment below and tell me that helped you the most. And also, if you want an in-depth video going over options, let me know in the comments and I'll be sure to do my best to make that video for you. Thank you so much for watching. I really appreciate your time. I'll see you in the next one.